I need to tell you about something that's been troubling me lately. Not in a dramatic way. I've never been one for theatrics, but in a way that keeps me up at night thinking about all the people who are about to make a catastrophic mistake with their wealth. Last week, I was having coffee with a friend who's 58 years old. Successful career, solid portfolio. He's accumulated what most people would consider substantial wealth over 3 decades of disciplined saving and investing. And he said something that stopped me cold. Howard, I'm just going to keep doing what I've been doing. It's worked for 30 years. Why change now? I understood exactly what he meant. I also understood exactly why he was wrong. You see, after managing money for over 5 decades, I've watched thousands of investors make the same fundamental error. They confuse the strategy that builds wealth with the strategy that preserves and deploys it. They're not the same thing, not even close. And if you're over 50 in 2026, understanding this difference isn't just important, it's the difference between financial security and watching decades of careful accumulation evaporate. I'm Howard Marks. I co-founded Oaktree Capital Management, where we've managed over $170 billion in assets. I've written investment memos for 35 years that Warren Buffett has said he reads first when they arrive. I've survived every major market crisis since 1970. And what I'm about to share with you comes from watching what separates investors who thrive in their later years from those who don't. This isn't about getting rich quick. If that's what you're looking for, you're in the wrong place. This is about recognizing that you're sitting on something extraordinarily valuable right now, a combination of accumulated capital, experience, and time horizon that creates opportunities most younger investors simply cannot access. But only if you understand how to think about it differently. Let me walk you through what I've learned about wealth after 50, why 2026 presents a specific moment of opportunity and risk, and how to position yourself for what I believe will be one of the most important financial decisions of your life. The first thing you need to understand is that wealth after 50 operates under completely different rules than wealth before 50, and I mean fundamentally different, not just slightly modified. When you're 30 or 40, time is your greatest asset. You can afford to be aggressive, you can afford to make mistakes, you can afford to ride out volatility because you have decades for markets to recover. Your strategy should be accumulation, building the pile, adding to it consistently, letting compound interest work its magic over long periods. But something changes when you cross 50. Suddenly, time shifts from being your greatest asset to being a constraint you must manage carefully. Your earning years are no longer infinite. Your ability to recover from a major drawdown becomes limited. And most importantly, your relationship with your capital needs to evolve from accumulation to strategic deployment. Here's what most financial advisors won't tell you. The traditional advice about gradually shifting from stocks to bonds as you age is not just oversimplified. In today's environment, it's potentially dangerous. I'm not saying bonds don't have a place. I'm saying the entire framework of thinking about your wealth needs to change. Think about what you actually have. If you're over 50 with accumulated wealth in 2026, you have capital that took decades to build. You have experience that younger investors lack. You have a clear view of your actual needs and timeline. You have the ability to be patient in ways that institutional investors who face quarterly redemptions and performance pressures cannot be. And you have access to opportunities that require exactly these characteristics. This is your fortune, not just the dollar amount in your accounts, but the combination of capital, experience, and positioning. The question is whether you recognize it and know how to unlock it. Now, let me tell you why 2026 specifically matters. I'm looking at a market environment that reminds me of several periods in my career, and none of them ended the way the consensus expects. We've just come through a period of extraordinary returns in certain segments of the market. Technology stocks, particularly anything related to artificial intelligence, have produced returns that would have seemed fantastical just a few years ago. Private equity has raised unprecedented amounts of capital. Real estate values, despite rising interest rates, have remained stubbornly elevated in many markets. And throughout all of this, investors have become increasingly confident that they understand how markets work. That confidence concerns me deeply. I've seen this pattern before. In 1999, investors were certain that technology had changed the rules of valuation. In 2007, they were certain that real estate was a one-way bet. In both cases, the certainty itself was the warning sign. Not because markets were about to crash, I never try to predict crashes, but because certainty blinds people to risk. Right now, I'm watching investors over 50 make decisions based on the assumption that what worked for the last 5 years will work for the next five. They're chasing returns in crowded trades. They're taking on leverage to boost yield. They're investing in complex structures they don't fully understand because everyone else is doing it. And they're doing all of this at precisely the moment when they can least afford to be wrong. But here's the opportunity hidden inside this risk. When everyone is zigging, the people who know how to zag intelligently can find extraordinary value. And if you're over 50 with accumulated capital, you have the exact characteristics needed to be a successful zagger. Let me explain what I mean by walking you through how I think about positioning wealth after 50. This isn't a formula. I don't believe in formulas. But it is a framework that's guided my thinking for decades. The first principle is understanding your actual risk tolerance versus your perceived risk tolerance. Most people think they know their risk tolerance. They don't. They know their risk tolerance in good times. They have no idea what their risk tolerance is when their portfolio drops 30% in 3 months and financial media is predicting the end of the world. I learned this lesson painfully in 2008. I watched investors who had told me they were comfortable with volatility panic and sell at exactly the wrong time. These weren't unsophisticated people. They were smart, successful individuals who genuinely believed they could handle market stress. But belief and reality are different things. If you're over 50, you cannot afford to discover your true risk tolerance during a crisis. You need to know it now, and the way to know it is to ask yourself a simple question. If your portfolio dropped 40% tomorrow and stayed there for 2 years, would you be able to sleep at night? Would you be able to stick to your strategy? Would you be able to avoid panic selling? If the answer is no, and for most people it is no, then you need to structure your portfolio differently than you think you do. Not because you're weak or unsophisticated, but because you're human. And humans make terrible decisions under stress. This leads to the second principle. Your portfolio should be structured for sleep, not for maximum theoretical return. I know this sounds conservative. It isn't. It's the most aggressive thing you can do because it allows you to stay rational when others panic. Here's what I mean. Let's say you're 55 years old with $1 million in investable assets. The conventional advice might tell you to put 60% in stocks and 40% in bonds. But that allocation is based on some theoretical model of optimal risk-adjusted returns, not on your actual psychology or your specific situation. Instead, I'd ask you different questions. What's your actual spending need? What's your time horizon for different buckets of money? What opportunities do you have access to that others don't? What's your ability to add capital if markets decline? What's your emotional capacity to handle volatility? The answers to these questions might lead you to a completely different allocation. Maybe you need to be more conservative than 60 to 40 because you're planning to retire in 3 years and can't afford a major drawdown. Or maybe you can be more aggressive because you have pension income that covers your expenses and your portfolio is purely for legacy. The point is that the right allocation is specific to you, not derived from some generic age-based formula. Now here's where it gets interesting for people over 50 in 2026. The market environment we're in creates specific opportunities that favor patient capital with a medium-term time horizon, not short-term trading, not infinite horizon endowment-style investing, medium-term patient capital, which is exactly what you have if you're over 50 with accumulated wealth. Let me give you some examples of what I'm seeing. In the private credit markets, there are opportunities to lend to quality middle-market companies at yields that haven't been available in 15 years. These aren't junk bonds, these are secured loans to profitable businesses that need capital for growth or refinancing. The yields are attractive because bank lending has contracted, and private equity funds have raised so much capital that they're competing aggressively for deals, creating opportunities on the lending side. If you're 35 years old, you probably can't access these opportunities. You don't have the capital, you don't have the network, you don't have the experience to evaluate credit risk. But if you're 55 with accumulated wealth and business experience, you might be able to participate directly or through funds that have minimums that younger investors can't meet. Similarly, in distressed debt and special situations, I'm seeing pockets of genuine value created by forced selling and market dislocations. When interest rates rose rapidly in 2022 and 2023, certain strategies that had worked for a decade stopped working. Funds faced redemptions. Investors panicked. And quality assets got sold at discounts that made no sense based on their fundamental value. These opportunities don't show up on CNBC. They don't have ticker symbols. They require patience, diligence, and capital that doesn't face redemption pressure. Again, this is exactly what you have if you're over 50 with accumulated wealth. But, and this is crucial, you have to be willing to think differently than the crowd. You have to be willing to look at opportunities that aren't popular. You have to be willing to be patient when others are chasing momentum. And you have to be willing to accept that you might look wrong for a while before you're proven right. This brings me to the third principle. The best opportunities are usually found where other people aren't looking. I've built my entire career on this insight. When everyone is buying technology stocks, look at value stocks. When everyone is piling into real estate, look at distressed debt. When everyone is chasing yield and high-yield bonds, look at senior secured loans. In 2026, everyone is talking about artificial intelligence, cryptocurrency, and the next big thing. Very few people are talking about boring, cash-flowing businesses that trade at reasonable valuations. Very few people are talking about high-quality bonds that yield 6 or 7% with minimal credit risk. Very few people are talking about real assets that provide inflation protection without the volatility of commodities. These aren't sexy investments. They won't make you rich overnight, but they provide the foundation for a portfolio that can compound steadily while protecting your downside. And if you're over 50, protecting your downside is more important than maximizing your upside. Let me be specific about what I mean by downside protection, because this is widely misunderstood. Downside protection doesn't mean avoiding volatility. It doesn't mean never losing money. It means structuring your portfolio so that a bad outcome doesn't derail your life plan. I learned this from my mentor, and it's guided every investment decision I've made for 50 years. Before you make any investment, ask yourself, what has to happen for this to work? What has to happen for this to fail catastrophically? Can I survive the catastrophic scenario? If you can't survive the catastrophic scenario, you shouldn't make the investment, period. It doesn't matter how good the expected return is. It doesn't matter how unlikely the bad outcome seems. If the bad outcome would devastate you, the investment is inappropriate for you regardless of its theoretical merits. This is especially important if you're over 50 because your ability to recover from devastation is limited. If you're 30 and you lose half your wealth, you have decades to rebuild. If you're 60 and you lose half your wealth, you might not have time to recover before you need to start drawing on your capital. So the fourth principle is this: structure your portfolio so that no single decision can ruin you. This sounds obvious, but you'd be amazed how many smart people violate this rule. They put too much money in their company stock. They concentrate their real estate holdings in one market. They leverage up to boost returns. And when something goes wrong, and something always eventually goes wrong, they're devastated. Diversification isn't just about owning different stocks. It's about having genuinely uncorrelated sources of return. It's about having some assets that will hold value if stocks crash. It's about having some liquidity if opportunities arise. It's about structuring your affairs so that no single scenario can destroy you. Now, I want to address something that I know some of you are thinking. Howard, this all sounds very conservative. Where's the fortune you promised to help me unlock? This sounds like you're telling me to play defense. Here's what you're missing. Playing great defense is the most aggressive thing you can do because it allows you to play great offense when opportunities arise. Let me explain what I mean. In 2008 and 2009, when markets were collapsing and everyone was panicking, Oaktree raised $11 billion to invest in distressed debt. We weren't able to do this because we were smarter than everyone else. We were able to do it because we had positioned ourselves conservatively going into the crisis. We had dry powder, we had patient capital, we had the emotional fortitude to buy when everyone else was selling. The investors who made the most money in 2008 and 2009 weren't the ones who predicted the crisis. They were the ones who had positioned themselves to take advantage of it when it arrived. And the way you position yourself to take advantage of opportunities is by not being fully invested when everyone else is fully invested. This is the fortune I'm talking about if you're over 50 in 2026. You have the capital, you have the experience, you have the patience. What you need is the positioning. And the positioning means having some dry powder, some cash or near cash investments that you can deploy when opportunities arise. I know what the objection is, but Howard, cash yields nothing. I'm losing to inflation. I'm missing out on market gains. Maybe. But maybe you're buying insurance against missing the opportunity of a lifetime when it arrives. And if you're over 50, catching one or two great opportunities can matter more than squeezing out an extra percentage point of return every year. Let me give you a specific example of what I'm talking about. Suppose you're 58 years old with $2 million in investable assets. The conventional approach might be to have $1.2 million in stocks, $600,000 in bonds, and $200,000 in cash. But what if instead you structured it differently? What if you put $1 million in a diversified portfolio of quality stocks and bonds that you're comfortable holding forever? What if you put $500,000 in income-producing assets like private credit or real estate that generate cash flow? And what if you kept $500,000 in cash or short-term treasuries specifically designated as your opportunity fund? The first million is your foundation. It's not going anywhere, and you're not trying to trade it or optimize it. The $500,000 in income-producing assets provides cash flow and diversification. And the $500,000 opportunity fund is waiting for the moment when everyone else is panicking and you can buy quality assets at distressed prices. This structure might underperform in a raging bull market, but it will dramatically outperform if we get any kind of significant market dislocation. And more importantly, it will let you sleep at night knowing that you're prepared for multiple scenarios. This leads to the fifth principle. Your wealth after 50 should be structured for optionality, not optimization. Optimization means squeezing out every last basis point of return. Optionality means positioning yourself to take advantage of whatever opportunities arise. Young investors should optimize. They have time to recover from mistakes. They have decades for compound interest to work. They should be pushing for maximum returns within their risk tolerance. But if you're over 50, optionality matters more than optimization. The ability to act when others can't is worth more than an extra percent of return. Now, let me talk about something that makes many financial advisors uncomfortable: the role of alternative investments for people over 50. I'm not talking about cryptocurrency or SPACs or whatever the latest craze is. I'm talking about genuine alternative investments that provide different risk-return characteristics than stocks and bonds. The traditional 60-40 portfolio was designed for a world where stocks and bonds had negative correlation. When stocks went down, bonds went up, and vice versa. But we've entered a period where that relationship has broken down. In 2022, both stocks and bonds fell significantly at the same time. The diversification benefit that investors had counted on for decades disappeared. This means that if you're over 50 and you're relying on a traditional portfolio for diversification, you might be taking more risk than you realize. You need to think about genuine diversification, which means assets that truly behave differently than stocks and bonds. This might include private credit, where you're earning yield that's contractually obligated rather than dependent on market sentiment. It might include real assets like infrastructure or farmland that have different drivers than financial assets. It might include strategies like merger arbitrage or distressed debt that profit from specific situations rather than broad market moves. The key is that these alternatives need to be genuine alternatives, not just stocks and bonds in disguise. And you need to understand them well enough to know what you're getting into. If you don't understand an investment, you shouldn't own it, regardless of how attractive it sounds. This brings me to the sixth principle. Complexity is not sophistication. Some of the best investments I've ever made have been simple and boring. Some of the worst investments I've seen other people make have been complex and exciting. If someone is pitching you an investment that requires a 50-page prospectus to explain, be very skeptical. If someone tells you about a strategy that sophisticated investors use but you don't fully understand, walk away. If someone promises returns that sound too good to be true, they are too good to be true. Your wealth after 50 is too important to risk on things you don't understand. Stick with investments where you can clearly explain the source of return, the risks involved, and the scenario where you'd lose money. If you can't do that, you have no business owning the investment. Now, I want to address something specific to 2026 that I believe creates both risk and opportunity: the changing interest rate environment. For 15 years, from roughly 2008 to 2023, we lived in a world of near zero interest rates. Investors were forced to take more risk to generate any meaningful return. That world is over. Interest rates have normalized. You can now earn 5% or more on safe short-term treasury bills. High-quality bonds are yielding 6 to 7%. This changes everything about how you should think about your portfolio if you're over 50. For the first time in 15 years, you can build a meaningful portion of your portfolio around income without taking excessive risk. You don't have to chase yield in junk bonds. You don't have to buy dividend stocks that might cut their dividends. You don't have to invest in complex credit structures you don't understand. You can simply buy high-quality bonds and earn a decent return. This is a profound shift, and most investors haven't fully adjusted to it yet. They're still in the mindset of the zero-rate world where you had to take risk to earn anything. But that's no longer true, and if you're over 50, this shift creates an opportunity to restructure your portfolio around more stable, predictable income sources. But, and this is important, higher interest rates also create risks. Companies that borrowed heavily when rates were low now face higher refinancing costs. Real estate values that were supported by cheap debt are under pressure. Private equity funds that used leverage to boost returns are struggling. And investors who chased yield without understanding credit risk are facing losses. This is why the seventh principle matters so much. In investing, what you don't lose matters more than what you make. I've said this so many times that people probably think I'm obsessed with it, but it's true. If you lose 50% of your capital, you need to make 100% just to get back to even. The math of losses is brutal. If you're over 50, you can't afford to take big losses. You don't have time to recover. You don't have unlimited earning power to replace lost capital. You need to structure your portfolio so that your downside is protected, even if it means giving up some upside. This doesn't mean being timid. It means being thoughtful about risk. It means understanding that volatility and risk aren't the same thing. It means recognizing that the best investment is often the one you don't make. Let me give you a practical example of how to think about this. Suppose someone offers you an investment that has a 70% chance of returning 20% and a 30% chance of losing 40%. The expected return is positive. A young investor with a long time horizon might take that bet. But if you're 60 years old and that investment represents a significant portion of your wealth, you probably shouldn't take it. The 30% chance of a 40% loss is too devastating relative to your ability to recover. This is what I mean by understanding your personal relationship with risk. It's not about being conservative or aggressive in some abstract sense. It's about being honest about what you can afford to lose and structuring your portfolio accordingly. Now, let me talk about something that's often overlooked in discussions about wealth after 50. The psychological aspects of managing money. This isn't touchy-feely nonsense, it's practical reality. Your ability to stick with a strategy during difficult times matters more than the strategy itself. I've watched brilliant investors with perfect strategies fail because they couldn't handle the emotional stress of seeing their portfolio decline. I've watched mediocre investors with imperfect strategies succeed because they had the discipline to stick with their plan through thick and thin. Psychology matters. If you're over 50, you need to structure your portfolio in a way that allows you to be psychologically comfortable. This might mean being more conservative than optimal. It might mean sacrificing some return for peace of mind. And that's okay. A slightly suboptimal portfolio that you can stick with is infinitely better than an optimal portfolio that you abandon at the worst possible time. This is why I keep coming back to the importance of understanding yourself. What keeps you up at night? What would make you panic? What would cause you to make an emotional decision that you'd regret? Build your portfolio around these answers, not around some theoretical model of optimal returns. Here's what I want you to take away from all of this. If you're over 50 in 2026, you're sitting on something valuable. Not just your accumulated capital, but your accumulated experience, your patience, your ability to think long-term, and your positioning to take advantage of opportunities that others can't access. But to unlock this fortune, you need to think differently than you did when you were building wealth. You need to shift from accumulation to strategic deployment. You need to prioritize downside protection over upside maximization. You need to structure for optionality rather than optimization. You need to be willing to look at opportunities others are ignoring, and you need to be honest with yourself about your true risk tolerance and time horizon. The market environment in 2026 creates specific opportunities for patient capital with a medium-term horizon. Interest rates have normalized, creating income opportunities that didn't exist for 15 years. Certain market segments have become crowded and expensive, creating opportunities in less popular areas. And the combination of geopolitical uncertainty and economic transition creates the potential for dislocations that favor prepared investors. But none of this matters if you're not positioned to take advantage of it. And positioning means having the right structure, the right mindset, and the right discipline to act when others are paralyzed by fear or greed. I don't know what's going to happen in markets over the next few years. Nobody does. But I know how to position for multiple outcomes. I know how to protect downside while maintaining upside optionality. I know how to be patient when others are frantic. And I know that these skills, combined with accumulated capital and experience, create opportunities that simply aren't available to younger investors. That's your fortune, not a guarantee of returns, not a promise of easy money, but a genuine advantage if you recognize it and know how to use it. The question is whether you'll take the time to think through your positioning, understand your true risk tolerance, and structure your wealth in a way that serves your actual needs rather than some theoretical model. I hope you will, because I've spent 50 years watching people make these decisions, and I can tell you with certainty that the ones who think carefully about these questions end up in a much better place than the ones who just keep doing what they've always done. That's what I've learned. Now it's up to you.